transaction clears at 9:47 a.m. Eastern Time. Not slowly, not through intermediaries. A direct purchase. China acquires 8,133 metric tons of American gold reserves in a single coordinated operation. The largest gold transfer between nations in modern history. After that, the financial architecture of the global economy starts recalculating itself. This is a simulation. But the gold reserves? Real. The market mechanisms? Pulled directly from Federal Reserve data and commodity trading systems. The geopolitical implications? Based on how central banks actually operate. Your retirement account, the dollar in your wallet, the mortgage rate on your house, all connected to what just moved from Fort Knox to Beijing. Most people think the first impact would be the dollar crashing overnight. They're wrong. The dollar doesn't crash. Something stranger happens. Something that creates winners and losers in places you'd never connect to a gold transaction. By day 9 of this scenario, a financial mechanism activates that hasn't been used since the Bretton Woods collapse in 1971. It's not what breaks. It's what happens when central banks worldwide realize the mathematical foundation of currency valuation just shifted underneath them. Somewhere in a trading room in London, a currency analyst is staring at a screen showing Treasury yields moving in a direction that violates every economic model she knows. This is how it begins. Here's the actual mechanism. The United States holds 8,133 metric tons of gold in reserves. At current prices, roughly $630 billion worth. It's stored across multiple facilities. Fort Knox in Kentucky, West Point in New York, the Denver Mint, the Federal Reserve Bank of New York. This gold doesn't back the dollar directly anymore. Not since 1971, but it serves as a financial anchor, a signal of stability, a last resort asset. China currently holds approximately 2,300 metric tons of gold reserves. They've been accumulating quietly for years, buying 5 tons here, 15 tons there. Never enough to move markets dramatically, but consistent, deliberate. In this simulation, China makes a different calculation. Instead of gradual accumulation, they propose a direct purchase. All American gold reserves. The offer? $780 billion. That's 24% above current market value. A premium that makes the transaction economically rational for the U.S. government, which is running a $1.7 trillion annual deficit. The mechanism works through the International Monetary Fund protocols, not a cash transaction. A series of coordinated sovereign debt swaps, Treasury bond exchanges, and digital reserve transfers that take 72 hours to execute completely. The first ripple? Currency markets in Asia. They're open when the transaction completes. The yuan doesn't strengthen dramatically, but Treasury yields, the interest rate the U.S. government pays to borrow money, tick upward by 0.23% in 90 minutes. Not because of panic, because of math. Here's what most people miss. That gold sitting in Fort Knox doesn't just represent metal. It represents confidence in the dollar's stability. When it transfers to China, the psychological foundation of global reserve currency status shifts slightly. And in financial markets, slight shifts in trillion-dollar systems create massive secondary effects. But there's something deeper. The transaction sends a signal to every central bank on the planet. The United States just valued immediate budget flexibility over long-term reserve asset retention. That signal gets interpreted, analyzed, and acted upon. Let's look at the actual numbers. The US dollar comprises 59% of global foreign exchange reserves. Central banks worldwide hold $6.5 trillion in dollar-denominated assets. The entire global financial system prices commodities, settles trades, and values currencies against the dollar as the baseline. This isn't speculation. These are Bank for International Settlements figures. IMF reserve data. The numbers are real. The scenario is hypothetical. The math? That's just arithmetic. Now here's what surprises most people. The first reaction isn't China becoming economically dominant. China already holds $3.4 trillion in foreign exchange reserves. Adding $630 billion in gold is significant, but not transformative for their balance sheet. The first critical reaction? European central banks. The European Central Bank holds 10,127 metric tons of gold across member nations. The Bank of England holds 310 tons. The Bundesbank in Germany holds 3,255 tons. These institutions watch America sell its entire strategic reserve and immediately recalculate their own positioning. A meeting convenes in Frankfurt, not publicly announced. The ECB Governing Council discusses a question that has not been seriously considered in 40 years. Should Europe maintain its gold reserves when America apparently does not value its own? The answer they reach isn't unanimous, but the conversation itself changes something fundamental. The mechanism is clear. The timeline is predictable. What's not predictable? How markets respond when confidence starts shifting beneath the surface. And it's about to shift. Day 2. The U.S. Treasury announces the transaction publicly. The framing is careful. Strategic asset rebalancing to support infrastructure investment and deficit reduction. The word selling is never used. It's a transfer of reserve assets in exchange for economic modernization capital. Financial journalists parse the language. The asset was sold. The semantics don't change the reality. Within 6 hours, gold prices move, not the direction most people expect. Gold drops 4.3% in a single day, the largest single-day decline in 18 months. Why? Supply and demand basics. If the U.S. doesn't value gold as a reserve asset, the global perception of gold's importance declines. Investors who held gold as a hedge against dollar instability suddenly question the logic. If America sold it all, maybe it's not the safe haven everyone assumed. A portfolio manager at a pension fund in California makes a decision. The fund holds $840 million in gold ETFs. She sells 30% of the position. It's not panic, it's recalculation. If the U.S. government doesn't want it, maybe it's not the inflation hedge she thought it was. 8,000 institutional investors make similar calculations over the next 48 hours. Gold drops another 2.1%. Meanwhile, currency traders are watching a different signal. Treasury yields are still rising, slowly, steadily. The 10-year Treasury note hits 4.83%, up from 4.52% before the announcement. A bond trader in Singapore runs a calculation. Rising yields mean the U.S. government is paying more to borrow money. That means either markets are demanding higher returns because they perceive increased risk, or demand for treasuries is declining because foreign central banks are reducing their dollar holdings. He checks foreign reserve data. It's too early to see movement, but the yield increase tells him something is happening beneath the surface. Day 3. China makes its first strategic move with the newly acquired gold. They announce a new gold-backed yuan settlement system for international trade. Not a gold standard, something different. A parallel settlement mechanism where certain international transactions can be cleared in yuan, with the exchange rate partially stabilized by gold reserves. It's technical, complicated. Most people don't understand the implications immediately, but a commodity trader in Dubai understands perfectly. Oil sales. The global oil market processes $2.1 trillion in annual transactions, almost entirely denominated in US dollars. If China offers an alternative settlement mechanism backed by the world's largest gold reserves, some oil-producing nations might accept it. Not all, but some. Saudi Arabia watches the announcement carefully. Day 5. The second-order effects begin appearing. Not in spectacular market crashes, in small structural shifts. India's central bank announces an accelerated gold acquisition program. They're not selling reserves, they're buying more. The logic: if the US devalued gold's importance and China increased theirs, India needs to ensure they're not left behind in whatever new financial architecture is forming. Russia makes a similar announcement within 18 hours. A pattern is emerging. Central banks globally are polarizing. Some follow America's lead, viewing gold as a legacy asset. Others follow China's lead, viewing it as newly strategic. The financial system is fracturing along a fault line nobody predicted. A currency analyst at J.P. Morgan Chase writes an internal memo that leaks within 24 hours. We are witnessing the early stages of a multipolar reserve currency system. The dollar will remain dominant, but its exclusivity is declining faster than models predicted. The word multipolar starts appearing in financial journalism. Day 7. The first consumer-facing impact appears, not in stock prices, in mortgage rates. Banks use Treasury yields as the baseline for setting mortgage rates. When the 10-year Treasury hits 5.1%, mortgage rates move correspondingly. The average 30-year fixed mortgage rate increases from 6.8% to 7.4% in 1 week. A couple in Ohio who were pre-approved for a $340,000 mortgage at 6.8% suddenly find that same mortgage at 7.4% costs them an additional $187 per month. Over 30 years, That's $67,320 more in interest payments. They don't connect it to a gold transaction in Fort Knox. They just know buying a house got more expensive, fast. Real estate agents across the country start seeing deals fall through, not at crisis levels, but enough to notice. A 12% decline in pending home sales over 10 days, but grocery stores and gas stations, unchanged. This isn't affecting daily life. Not yet. It's affecting long-term financial calculations. Mortgages, retirement accounts, college savings plans, day 8. The stock market finally responds, not with a crash, with volatility. The S&P 500 swings 2.3% intraday. Up in the morning, down by afternoon, up again near close. Algorithmic trading systems are reacting to signals they're not programmed to fully interpret. The gold sale itself is priced in. But the cascading implications, those are creating uncertainty. Uncertainty is the variable markets hate most. A retirement account holder in Florida logs into his 401k and sees his balance down 4.8% from 2 weeks ago. He's 58 years old, planning to retire at 65. The math just changed. He might need to work another year, maybe 2. He doesn't know why it changed, just that it did. Meanwhile, China is executing the second phase quietly. They're not announcing it. But trade data shows the pattern. Chinese purchases of commodities, copper, lithium, rare earth minerals, increased by 17% in 1 week. They're using the dollar proceeds from the complex financial instruments they exchange for gold, buying physical assets while the dollar is still strong. It's a calculated conversion. Financial assets into real resources. The strategy becomes visible only in retrospect. Day 10. A currency crisis that nobody predicted occurs, not in the US, in emerging markets. Argentina's peso drops 11% in 36 hours. The Turkish lira falls 8%. The South African rand declines 6%. Why? These countries hold significant dollar-denominated debt. When Treasury yields rise, their debt servicing costs increase. When the dollar's long-term stability becomes even slightly questioned, capital flows out of emerging markets and into perceived safer assets. The gold transaction didn't cause this directly, but it created the conditions that triggered it. An economist in Buenos Aires watches the peso fall and makes a connection most people miss. When the center wobbles, the periphery collapses first. Day 12, the Federal Reserve makes its first major intervention, an unscheduled statement from the chair. The US dollar remains the world's primary reserve currency, backed by the full faith and credit of the United States government and the world's largest economy. Notice what's not mentioned: gold. The statement is meant to calm markets. It has the opposite effect, because now investors know the Federal Reserve is concerned enough to issue an unscheduled statement. A hedge fund manager in Connecticut reads it and immediately shorts Treasury bonds, not because he thinks the dollar will collapse, but because he thinks yields will keep rising as the Fed struggles to maintain credibility without the psychological anchor gold provided. He's not alone. Short interest in Treasury bonds increases by $23 billion in 72 hours. Not everything breaks. Some institutions adapt successfully. Several U.S. states with budget surpluses make an unexpected move. Texas, Wyoming, and Utah jointly announced they're establishing state-level gold reserves, buying what the federal government sold. It's symbolic more than practical. Their combined purchase is 15 tons, a fraction of what was transferred. But the signal matters. Subnational governments filling a vacuum left by federal policy. A political science professor at UT Austin writes an article that goes viral. We're watching federalism reassert itself in real time. When the center changes strategy, the states adapt independently. Private wealth managers see an opportunity. Several firms launched new investment products, gold-anchored dollar funds that hold both USD and physical gold. They're positioning for clients who want dollar exposure with a hedge against the exact scenario playing out. Assets under management in these funds grow from $840 million to $4.2 billion in 3 weeks. Demand is coming from people who still trust the dollar but want insurance. Meanwhile, an unexpected partnership forms. Japan and South Korea announce a regional reserve coordination agreement. They're not abandoning the dollar, but they're creating a parallel system for settling certain trade transactions in yen and won, with gold held in reserve by both nations. It's a defensive adaptation. If the global system is becoming multipolar, they're ensuring they have a position in multiple poles. These are the success stories: adaptive, strategic, forward-looking. But not everyone can adapt. Small banks face a different reality. Community banks with $500 million to $2 billion in assets hold Treasury bonds as safe, stable investments. When yields rise, bond prices fall. Their balance sheets take immediate hits. A community bank in Iowa holds $67 million in Treasury bonds purchased at lower yields. Those bonds are now worth $62 million, a $5 million paper loss. If they hold to maturity, they recover. But if depositors get nervous and withdraw funds, the bank might need to sell at a loss. The bank president sends a memo to the board. Monitor deposit flows closely. Prepare liquidity contingency plans. 300 similar banks across the country send similar memos. Credit unions face related pressures. They offer fixed-rate loans based on assumptions about their own borrowing costs. When those costs rise faster than expected, their margins compress. Some credit unions temporarily suspend new mortgage lending while they recalculate their risk models. A borrower in Nevada who was promised a mortgage rate gets a call. We need to reevaluate your application based on current market conditions. She's confused. Nothing about her financial situation changed, but the bank's risk calculation changed underneath her. Day 17. International effects intensify, not through crisis, but through strategic repositioning. Brazil announces it will accept yuan for certain commodity exports. Not exclusively, but as an option. The rationale is pragmatic. China is their largest trading partner and now holds the world's largest gold reserves. Having settlement flexibility makes economic sense. Chile follows within 48 hours, then Peru. A South American trading bloc is informally emerging, not anti-dollar, but dollar optional. An American soybean farmer in Illinois reads the news and doesn't immediately connect it to his business. But his grain elevator does. They're starting to see pricing quoted in both dollars and yuan for export contracts. It adds complexity, currency exchange risk, hedging costs. The farmer's profit margin was already thin. It just got thinner. Meanwhile, the European response crystallizes. The ECB doesn't sell its gold, but it doesn't buy more either. They're watching, waiting, hedging between American and Chinese positions. Germany makes a unilateral decision. The Bundesbank increases its gold reserves by 200 tons, purchased from private markets, not from other governments. It's a signal Germany is maintaining strategic flexibility regardless of what the US or China does. France interprets this as Germany hedging away from full alignment with US monetary policy. Old tensions resurface, not publicly, but in closed-door ministerial meetings. The European unity that seemed solid starts showing microfractures. Regular people make smaller adjustments that collectively matter. A software engineer in California refinances his mortgage before rates climb further. Investment behavior driven by news cycles rather than strategy creates short-term distortions. Gold ETFs see inflows of $12 billion in 3 weeks, even as gold prices remain volatile. Community responses emerge in unexpected places. A town in Colorado with a historic mining past sees a minor gold rush, not industrial mining. Small-scale prospectors trying placer mining in streams. It's economically insignificant, but culturally symbolic. When financial systems feel uncertain, people reach for tangible assets they can see and touch. By day 25, a pattern has crystallized. This is what the financial system looks like now. International trade is increasingly multi-currency. Dollar dominance is declining from 64% of settlements to 61% in less than a month. Treasury yields have stabilized at 5.2%, higher than before, but not catastrophically. Mortgage rates sit at 7.6%. Painful for buyers, but not market freezing. Gold prices have recovered to within 1.2% of pre-transaction levels. The initial drop reversed as non-US central banks accumulated. It's not collapse, it's recalibration, expensive recalibration. A graduate student studying international finance defends her thesis on currency systems. 6 months ago, she would have written that dollar dominance was structural and stable. Now her thesis argues for inevitable multipolarity. Her advisor asks, "What changed?" She points to the gold transaction. This showed that perceived permanence isn't permanent. That's the moment when theoretical becomes real. Day 30. The immediate volatility subsides. Markets find new equilibrium points, not where they were, somewhere adjacent. The dollar remains the dominant reserve currency, but the margin of dominance has narrowed. The euro gains 1.8 percentage points of global reserve share. The yuan gains 1.1 percentage points. The dollar loses 2.9 percentage points. These sound like small numbers. In a $23 trillion global reserve system, they represent $667 billion in repositioning. American households see tangible impacts. Car loans cost 0.4% more on average. Credit card interest rates increased by 0.6%. Student loan refinancing rates climbed by 0.5%. None of these are catastrophic individually. Collectively, they represent $127 billion in additional annual interest costs across American consumers. That's real money. Dispersed across 130 million households. An average of $976 per household annually. Not enough to break budgets. Enough to matter. But some things have changed permanently. Central banks worldwide have recalculated reserve diversity. The assumption that dollar reserves are sufficient has been replaced by strategies that include multiple currencies and gold. This means global demand for dollar-denominated assets is structurally lower. Not absent, lower. For the U.S. government, that translates to permanently higher borrowing costs. Every new Treasury bond issued pays slightly more interest than it would have before. The cumulative cost, roughly $34 billion annually in additional debt service. That's the direct fiscal cost of the gold transaction. Spread across the federal budget, it's manageable, but it's permanent. American corporations with international operations face a different calculus. Currency risk management becomes more complex when there's no single dominant settlement currency. A manufacturing company in Michigan that exports to Asia now needs to hedge currency exposure in 3 currencies instead of 1. The hedging costs reduce profit margins by 0.3%. Across the Fortune 500, that's approximately $18 billion in reduced profitability annually. Financial institutions adapt their infrastructure. Banks invest $7.2 billion collectively in multi-currency settlement systems. Technology that wasn't necessary when the dollar settled everything. These costs get passed to consumers through banking fees. The average checking account sees fees increase by $4.20 monthly. Small individually, significant in aggregate. Meanwhile, geopolitical relationships have subtly realigned. Countries that were firmly in the U.S. economic orbit now maintain optionality. They haven't switched allegiance. They've created alternatives. The international order hasn't collapsed. It's become more fluid, more negotiated, less automatic. A diplomat in Brussels describes it precisely. The assumption of American economic primacy hasn't ended, but the assumption that it's inevitable has. That distinction matters. The hidden cost that doesn't appear in any economic report, certainty. For 80 years, the dollar's role as reserve currency was taken as given, a fundamental constant in economic planning. Businesses made 30-year decisions, assuming dollar stability. Governments structured debt, assuming dollar demand. That assumption is now conditional. Not wrong, just not automatic. A CFO at a multinational corporation changes how she models currency risk for the next decade. Previous models assumed dollar volatility within a narrow band. New models assume wider variance. That wider variance means holding more reserves, taking fewer risks, growing more cautiously. It's prudent financial management. It's also slower economic growth. The aggregate effect across thousands of corporations making similar adjustments. 0.2% slower GDP growth annually. Over a decade, that's $680 billion in economic activity that won't happen. Not because of crisis, because of recalibration. Zoom out from the 30 days. What does this simulation actually show? It reveals something most economists understand academically, but rarely confront directly. Reserve currency status is partly economic and partly psychological. The economic foundation is the size and stability of your economy. The psychological foundation is the belief that your currency will remain stable and accessible. When the United States sold its strategic gold reserves, it didn't fundamentally weaken the economy, but it weakened the psychological anchor. The signal it sent was interpreted globally as a shift in priorities. Immediate fiscal flexibility over long-term reserve credibility. That interpretation created tangible consequences. Higher borrowing costs, more complex currency markets, reduced economic certainty. This isn't about whether the gold sale was strategically correct. Reasonable economists disagree. Some argue the $780 billion gain was worth more than the symbolic value of gold sitting in vaults. Others argue the intangible costs of reduced currency confidence exceeded the tangible gains. Both positions have merit. The simulation doesn't resolve the debate. It shows what happens when the trade-off is made. Remember that transaction clearing at 9:47 a.m.? In this simulation, the distance between the dollar is the unquestioned global reserve currency, and the dollar is the primary but not exclusive global reserve currency, was approximately 25 days. Not instant collapse, but fast enough that the systems designed to maintain dollar primacy couldn't fully prevent erosion. The scenario was hypothetical, but the mechanisms are real. The reserve currency dynamics are real. The trade settlement systems are real. The central bank strategies are real. The only hypothetical part was America selling all its gold. The real question this simulation raises isn't whether this exact transaction will happen. It's what other foundations of economic certainty are based more on perception than mechanics, and how quickly perceived stability can become actual volatility when confidence shifts. We built a global financial system on the assumption of dollar permanence. We got efficiency. We also got fragility when that assumption was tested. Whether that's the optimal architecture depends on how you value stability versus flexibility. There's no objectively correct answer. But after watching this simulation, you probably understand the stakes more clearly. The distance between dominant and diminished might be shorter than the time it takes to transfer gold from one vault to another. If this type of economic simulation interests you, the algorithm will show you similar scenarios. And here's the question I'll leave you with. If you're a central banker in Tokyo or Frankfurt watching this happen, at what point do you start quietly diversifying your reserves? The answer might already be happening.